scan this. Sovi is here. Let's level up. Central banks love trick questions, but this one breaks fast. Find the policy that lowers prices and raises unemployment in the short run. Lower price level and higher unemployment mean contractionary monetary policy because less money and credit reduce spending, output, and hiring in the short run. In a limited reserve banking system, raising the discount rate makes borrowing from the central bank more expensive. So banks lend less, the money supply shrinks, and demand cools. That cooling demand pushes prices downward and increases unemployment. So the policy that matches both effects is an increase in the discount rate. Well done! Option D. Scan now. Watch signs and avoid rushing. Trust the given effects, then check each policy against contractionary logic.